how little the normal everyday people actually know in the realm of financial literacy.
There's a big lack of financial literacy with regular clients.
What are the biggest mistakes that we see our clients commit to, basically?
I need to put 20% down.
Oh my God, they're so focused on that 20% that they can't see the forest for the trees, and it just drives me nuts.
Paying off credit cards, paying off collections all in one go isn't always necessarily the best way to optimize your credit score.
If you really want a lower rate, 20% down is not it.
Correct.
It's literally 90% of first-time home buyers have no idea.
Wow, I could be making money off of my savings. Wow, why do all these rich people have mortgages?
It's like robbing Peter to pay Paul, what?
Exactly.
And this is part of like financial illiteracy with so many people that just freaking blows my mind.
Correct. Financial institution will pay you to park your savings there.
The money you earn, isn't it worth it? Welcome, everyone, to another installment of the Escrow podcast. And I've got the one and only, the amazing and indomitable Daisy Garza with me today. We happen to work in the same office. And here is what happened and why we're talking here today is we were at Friendsgiving with a bunch of girls from the office and outside. And we got to talking about the financial literacy, the financial education, and how little the normal everyday people actually know in the realm of financial literacy. We are both in the mortgage space, but it doesn't mean that what we do is limited to mortgages only. We try to educate our clients. That's where our passion is, the two of us, that is educating our clients to the best of our ability in all things fiscal literacy and not just, again, confine it to this is your rate, this is your mortgage. And without much ado, Daisy, tell me a little bit, well, me and everybody else, tell us a little bit about yourself first, and then we'll launch.
Of course. Hi, everybody. I'm Daisy. I've been doing mortgages for 12 years, and I started with a financial planning background. So the mortgages that I was doing was for clients that had an entire team of people behind them. They had CPAs, financial advisors, tax preparers. It was an entire team of people working for the client and telling them, now's the time to take out a mortgage. We need to refinance you. Now's the time to buy or sell your stock. And so I learned a lot during that time. And I realized that there's a big lack of financial literacy with regular clients. And so that's kind of when I pivoted and I said, okay, I have so much to teach others. There's so much education that I need to make this transition. And this is where Ella and I really connected because we both have the same approach to mortgages for our clients where we use mortgage as a financial planning tool. You're not just working with us to get a 5% down mortgage at whatever the rate is. We'll tell you, hey, have you considered this? Have you looked into these types of accounts? It helps that we're not with a bank, so we're not pushing you into an account that we're selling or anything like that. It really is, hey, here's what we've learned in our years of experience working with financial advisors. Here's a couple tips that you may or may not need or take advantage of.
That is awesome. I mean, that's, like I said, it's a passion. Mm-hmm. It's not just slinging mortgages like some people say. And with that, I know you and I have talked before. What are the common mistakes that we see clients make when thinking about mortgage? We'll start with that because there are so many mistakes and errors and myths out there on the financial literacy side that it's like we're just barely going to scratch the surface.
Yes.
But what are the biggest mistakes that we see our clients commit to, basically, that we try to help them understand and not make?
Yes. The biggest ones would be, I need to put 20% down.
Oh my God.
I need to save. I got to put 20% down
Shocker.
payment. Yes. And there's so many tools available right now that a lot of clients don't realize. So for example, I ask people, well, I always ask them, what's the purpose behind the amount of down payment you're looking to do?
Oh my gosh. Same. I literally ask them, why?
Yes.
Why do you need to put 20% down?
Yes. And then once you get their answer, it's always, I'm trying to keep the payment to this X amount.
Or I want to get rid of mortgage insurance.
I want to get rid of mortgage insurance. And there's so much behind the scenes that you can structure your mortgage to not have mortgage insurance. You can structure your payment get to the payment that you're looking for without needing to put 20% down payment. And
I mean, case in point, and I'm sure you've seen this enough and you've suggested this enough to clients. Somebody wants to put 20% down, but they've got a crap ton of debts, car payments, credit cards, etc. Well, they're better off putting 10% down or even 5% down, but wiping out a lot of that debt. So in the end, it's a lower actually overall financial obligation combined.
Yes.
But they're so focused on that 20% that they can't see the forest for the trees, and it just drives me nuts.
Exactly. And also something that a lot of clients don't know about is a mortgage recast. So I always tell my clients, you know what? Why don't we start putting 10%, 5%, 15% down? You enter the home, give it a couple months, and depending on, hey, I like this payment or I want to lower it even further, you have the option of doing what's called a recast, which isn't a refinance. You're not paying refinance fees or anything like that. It's a super simple process. And if you decide to put additional down payment, you can at that time, regardless of whether your loan has closed.
And the cost is negligible. It's like between $300 to $500.
Yes.
So instead of a full-on refi for thousands, here you're only paying a few hundred.
Yeah, and it reamortizes your balance as if you had done it on the day of closing. And so it'll lower your payment. It won't change your rate or anything. It'll just lower your payment, and now you have a smaller balance. So that's a huge tool that a lot of people don't know and or take advantage of. And so whenever my clients say, hey, I need to put 20% down, it's like, okay, let's take a look. How can we get rid of mortgage insurance by using seller credit, which right now is a really big thing.
Right. Single premium MI.
Exactly.
Single premium financed MI.
Yes. Yep.
There are so many ways.
Buying down the rate. Yes.
Right. And this is what you get when you're talking to a true professional with the passion for what we do, as opposed to talking to a banker who literally has a box, has a production goal they have to meet, and really, frankly, doesn't give a shit about your financial success because they have to sell the financial product the bank offers where we don't.
Yes.
We actually have your financial success at the heart of what we do on the daily basis. It's not the commissions. It's your financial success.
Correct. And that's how Ella perfectly said it. The biggest difference is you can go to a loan officer and say, I'm looking to put 20% down, and they will check that box and give you your 20% down option, whereas we dive into your finances and we give you different options after looking at the structure and saying, hey, we'll present you the option that you requested, but then also show you other ideas and say, have you considered doing this? Have you thought about doing this? This might make better sense. And so at the end of the day, we present you with multiple options where, depending on where you are with your finances and in life, there might be an option that we presented that would make better sense. And the way we like looking at it is a lot of people will pay financial advisors. They'll pay a monthly fee for someone to review their finances. And I always tell my clients, hey, let's just get started because you get that review for free with us. You're not paying for a credit report fee. You're not locked into anything. It really is a no commitment review.
It's a free conversation.
Exactly. Yes.
Why not have it?
Yeah. And you can't get that anywhere else.
Mic drop. Right there.
Exactly.
The other side of, and that's what very few people understand, still on the subject of 20% down, is that the rate is actually higher.
Correct.
Marginally, but higher.
Yes.
At 20% down. And to the most people, it will sound counterlogical, right? They're putting more money down.
Mm-hmm.
But it's the reality because that's the first point of, as I call it, first point of no return, where the mortgage is not insured by mortgage insurance.
Correct. Yes.
So if you really want a lower rate, 20% down is not it.
Correct. Yeah. And that's the whole point of mortgage insurance, right? Because mortgage insurance is protecting the lender and therefore the rate is lower.
Right.
Yeah. Another thing we should brush up on is credit. A lot of people will pay credit items. Let's say they're thinking of applying for a mortgage. They'll be like, oh my gosh, before I apply, I need to pay off all my credit cards to make sure that I have the optimal credit score.
Hold it. I have one better. Yeah. My favorite is when clients call me and say, okay, I've been getting ready. I've paid all my debt.
Yes.
And by all my debt, they don't mean credit cards. They mean collections.
Yes.
That's even worse.
Yes. Agreed, because there's so many things, like I said, as a consumer,
You just don't know what you don't know.
Yes, exactly. Your job is not to be in with the credit reports, to have the knowledge of the way credit works. And that's okay. That's why you come to us, the professionals, so that we can review and tell you all these tips and tricks that we know from behind the scenes. And so paying off credit cards, paying off collections all in one go isn't always necessarily the best way to optimize your credit score. Most of these collections, a lot of people don't even realize that in order to really remove them from their credit report, they have to do a pay and delete.
And you can't always get that.
Correct. So then there's no point in paying your collection. If you cannot get the collection deleted off your credit report, there is no point in paying it.
Because what happens actually, and this is again counter logic to, again, normal people,
yes.
but we know it because we've been stewing in it for ages, is that whenever you pay collection, you're actually renewing the reporting, renewing the activity on a negative account. So if you left the collection alone, and technically it's supposed to drop off at 7 years, when you make a payment on it, guess what? That 7 years just went out the window because now the clock starts ticking from the date that you paid it, not from when it originated. So you just kind of shot yourself in the foot.
Exactly. And another thing too, with the age of credit items, people will pay off and close their oldest account.
Which is the worst they can do.
So if you have an account that's 10 years old and you've paid it to zero and you're not using it, a lot of credit companies will actually close out the account for inactivity. That is the worst thing you can do because now your 10-year credit account no longer exists and credit
it's not
is
scoring
based
you
off,
points.
Yes, credit is based off you using it and your history. And so, that's another huge misconception that we talk about all the time, that we're like, we need to get these tips out to our clients.
We absolutely do. And it's like, I feel like I'm beating the same damn drum all of the freaking time because it's been such a topic of my talks, my videos for so long. It's like, don't do it. Don't touch your credit before you actually apply. Let us tell you what to do. Let us tell you exactly how much to pay down, on what accounts. Because we have the professional tools.
Right.
They don't.
And we have a way of telling you specifically, hey, this will take 3 months, 6 months, 9 months. We will give you an exact timeline as opposed to a client just guessing and thinking, oh, if I just pay these 5 off, who knows how long it'll take, but I know something's going to happen. We're able to actually put that on paper and show you exactly a plan that says, 30 days, 45, 3 months, whatever it may be.
I mean, case in point, I have a client right now I'm working with in Florida who was going to just, say, I'm going to pay all of my cards off. I'm like, no, dude. And we did need to raise the credit score a little bit. Like, let's model it.
Yeah.
We modeled it to the T, how much 3 of the accounts had to be paid down to reach the score that we needed.
Yeah.
As opposed to just paying them off. Paying them off actually didn't move the needle. Leaving the balances on did. So that's where, again, that's the true professionals. The whole point is you want to work with true professionals and also those that have a passion about it, the passion to help you, as opposed to check, next, take a number.
And you'll see the difference between someone who's passionate about mortgages and helping clients versus someone that isn't. You'll know as a consumer, you talk to a loan officer who just checks a box, and that's the type of service that you'll get.
The personality of a wet noodle.
Exactly. Versus someone who's really passionate and cares about your financial success. And if they're providing you with options, know that it's someone that cares to help you make the right decision. So
that's kind of what we're about. So those are the biggest probably mistakes that we see. But we also see a lot of financial mismanagement, unfortunately. And our position is, and that's what I tell my clients all the time, and I'm sure you do the same, is I don't judge. My job is not to judge. We all have made mistakes. I'm not perfect either. I've made my share of some pretty egregious financial mistakes over the years. I was young once.
Yes.
But our job is to push you in the right direction, help you put a plan together to get you into a better spot. Help you understand the mechanics behind the screens.
Yes.
And part of it is just having a very honest and open conversation about money.
I agree with Ella in that I always tell my clients this as well. We don't judge. We don't care. We have seen it all, and we see it so frequently. We review credit and finances multiple times on a daily basis that I tell my clients, we look at it so much. I truly don't care what you're spending your money on. I'm not combing through it, judging you.
And you can't really shock us anymore either, for that matter.
When we say we've seen it all, we've seen it all. Yes. So that doesn't matter to us. We're just looking at it from what is that saying? An eagle perspective, a viewpoint where you're
Eagle's viewpoint or something.
Eagle's viewpoint, where we're just looking at the full picture, and it's okay. Here's where we are. Here's the problem, right? Here's what our solution is going to be. How do we get there? That's what we focus on. How we're going to get from point A to point B, regardless of whatever happened to get you to this point.
As I say, usually, I understand you may be embarrassed. I understand that you feel bad about what happened. I get it.
Mm-hmm.
But look at it this way. What we're doing right now, we're driving on the freeway at a pretty high speed. Can you do that looking in the rearview mirror?
Exactly.
Probably not. So we're focusing on the forward. We're focusing on the windshield. Yes, you do need to glance in the rearview mirror every so often to see if there's nobody behind you, like the police, for example.
Yeah.
But on a serious note, looking back in the rearview mirror is learning from your mistakes. Looking forward through the windshield is moving forward on a path. And that's what we are here for, is provide the navigation for the path.
Correct. And so one of those tools that, gosh, I harp about it. Every client that I've had knows this because I always touch on this. Something that people are not taking advantage of are high yield interest savings accounts. Those are accounts where the bank or the financial institution will pay you to park your savings there. No one knows about this because regular banks like Wells Fargo, Chase, Bank of America, they don't make money with a regular savings account, right? So you'll leave your money with them and they pay you 0.01%.
And my personal pet peeve, and I think yours too, is that when you're banking with a big box bank or try to save your money there, you're effectively paying them to use your money.
Correct.
They're not paying you. You are paying them to use your money to bolster their balance sheets.
Exactly. Yes.
As opposed to the local credit unions, the small community banks that actually are membership-based, usually the credit unions specifically. So you don't pay for the privilege
Correct.
of a big box bank name on your bank statement, but you don't pay monthly fees for the accounts.
Correct.
The wire fees are cheaper. The cashier's check are
yeah.
free or next to free. You can actually talk to a person.
Right.
You can walk into a branch and they will know you. I mean, there were, my husband would walk into our credit union branch and be greeted with, Mr. Michael, good morning.
Yeah, it makes a big difference. And like Ella said, so if you open a regular savings account with a traditional bank, they'll pay 0.01%, if that. Most of the time, it's a little bit less. A high yield interest savings account, which a lot of credit unions right now are paying more. So they'll pay anywhere from 4 to 6% for you to have your savings there.
That is significant.
Huge.
That is absolutely freaking huge.
That is so depending on how much money you have saved, and a lot of people have money squirreled away that they don't even know how much interest they can be making, but that would pay a tank of gas. Look at the gas prices right now. That could pay a monthly tank of gas, groceries. It can pay for, once you're ready to buy, an inspection. It can cover loads of things that people don't even realize, wow, I could be making money off of my savings.
That's where, Darren Hardy says, small hinges swing big doors.
Yeah, exactly.
This is one of those small hinges that people don't even think about it.
Yeah.
They just look at the big door and get discouraged.
Yeah. And that's something too that I review with my clients as well, especially the ones that are looking at putting large down payments. I will do the math and say, hey, did you know that if you opened up a high yield interest savings account, the interest that you could be making on, let's say this 10%, if you move it in here, you would be making more in interest than you would be in the savings on the monthly payment.
And that actually segues into another great conversation, and that's about people not understanding that the mortgage interest is not bad.
Exactly.
It's actually a tax deduction, and a huge one at that.
Correct. And the way rich people leverage their finances is something that needs to be looked at and mimicked to a point, because I'll never forget when I was young and impressionable and I joined wealth management mortgages, my first question was, wow, why do all these rich people have mortgages? If they have the money to pay for it, why do they have mortgages?
Because their money is making them more money.
Exactly.
And they get a tax deduction.
Exactly. Because your money could be making you more money, and a mortgage allows you to get a tax deduction that you can't get with other things. And so that's something that I talk to my clients about, especially with the rates and where they are, is explaining those tax deductions the way, obviously you need to work with and talk to a CPA, but there's so many benefits to having a mortgage and a higher rate that not a lot of people are aware of.
I mean, let's take, I don't know, $450,000 mortgage just as a kind of average, right?
Mm-hmm.
At the current interest, somewhere around 6%.
Right.
The interest deduction for the first few years, because that's where the majority of interest or the majority of the payment goes towards the interest. That's 20 plus grand right there, 24, 26, kind of depends on the exact loan amount. That is a tax deduction.
Correct.
Property taxes now with the new SALT deduction having increased is another huge deduction in most states. I mean, in Arizona, the property taxes are pretty small.
So low, yeah.
In the majority of states, the property taxes are so damn high.
Yes.
Like my home in Oregon, almost $8,000 on a regular home, for God's sakes.
I was just looking in Washington. My sister lives out there.
Same, about
property
7,
taxes, $8,000.
Exactly. Mine are pushing 8 at this point too. So you add the 24, let's say 25,000. Plus 8,000 for property taxes. And now, again, if you're under a certain income limit, mortgage insurance is tax deductible too. So you get a huge chunk to take off the top via itemized deduction versus standard deduction, which for this year, if I'm not mistaken, is $26K, right?
Right. Yeah.
And next year goes to $29, but it's still higher than.
Yes.
So if your itemized is higher than the standard, you'd be a fool to not take it.
Yeah. Exactly.
Because that's money saved. So whatever your tax bracket is, if your tax bracket is 25%, so that difference of maybe 10 grand between the itemized and the standard, that's $2,500 back to you.
Correct.
Or a reduction in the taxes you owe. So that's
another
chunk change, right?
Yes, a huge unknown that a lot of people don't, they don't realize. Or you talk to someone that's renting and they say, oh, well, I'm renting because
it's cheaper.
It's cheaper. Right.
It's more convenient.
Correct. And then you ask them, well, that's when you start asking these questions. Well, what's your income? What tax bracket are you in? Again, a true knowledgeable loan officer will care to ask these questions because they want to make sure to offer you that advice, those opinions that you might not know about.
The aha moment was, I'd say, probably 90% of my first-time home buyers when I tell them about the tax deduction for interest and everything else is incredible.
Yeah.
It's literally 90% of first-time home buyers have no idea.
Yeah. Oh, I had a client just now who purchased the home that she'd been renting for 12 years. Yes.
I roll.
And I told her about the tax deduction, and she said, oh my God, I've missed out on this for the last 12 years.
And in those 12 years, she's paid half of her landlord's mortgage.
Correct. Exactly.
If not more.
Yes. And that's another.
And gave them a tax deduction.
Exactly. And that segues into another topic, which is the equity that you build in your home, right? So every month that you make a mortgage payment, it is going towards, I call it an unknown secret savings account, which is the equity you have in your home.
I call it the forced savings.
Yes, yeah, forced savings. That's a better word, because a home forces you to save that money. It is not gone. It's not like rent, right? Rent, you pay that once and you never see it again.
I love it when people say, especially when the interest rates hiked like over 8, well, I'm paying rent. I'm not buying a house paying 8% interest. Your interest right now is 100%.
Correct.
Because you're paying rent.
Exactly.
So guess what? You're wrong.
Yeah. And buying a house, you're hedging against rent inflation. You have
against inflation, period.
Correct. You have no control over inflation. You've seen, we have no control over what grocery, gas, what anything climbs up to, we have no control over, but we can control our mortgage. Yep. And that is something that if you get a mortgage, you're locking that payment in for the 30 years, 15 years, whatever.
I refer to it as buying your rent control.
Yes. Yes. You are buying rent control.
For yourself.
For yourself. And getting a forced savings account out of it, which you can tap into at any point. Right?
And it literally does become, I know it's a beaten to hell expression. I know it's a cliche, but it is the nest egg. It is the source of American wealth.
Correct.
Because there is not a single rich person out there who doesn't own their real estate.
Mm-hmm.
I mean, how else can you put it? I know it's a cliche, but it's a cliche for a reason.
Right.
Because it's generational wealth that's built through home ownership.
Correct. And for example, like when homes here in Arizona climbed overnight around COVID, someone who had bought a house for $200,000 was now sitting on an equity surplus. You know, the houses went from $200,000 to a starter home $450,000. They made $250,000.
Damn near overnight.
Right. Without having to do anything on top of the payments that they'd been making for the home all those years. And what we do get is we get a lot of pushback. Well, what if the market crashes again? And what if values go down? Then you don't sell. You sit on it for as long as you can until those values start to climb again. You're not.
I mean, Daisy, case in point. Mm-hmm. My house, and I don't know if you owned a house in the crash. Mm-hmm. My house in Oregon dropped, so I had it refinanced right before the crash. Mm-hmm. It appraised for $500K. Our values went down, not as bad as Arizona did, thank God, but still our values went down about, and again, part of town where I was at, 25% or so, mm-hmm. maybe 30 at most, but I think it was about 25%. Not has it already gone way past it and over, but no matter how much I was hurting in that financial rough time,
right.
and I was, the idea of, just because my house dropped in value, the idea of dumping the house was absolutely idiotic to me, because my payment, yes, it was a struggle to make the payment. Not going to lie. I mean, it was an absolute freaking hell for about 2 years. But my payment was lower than the rents. Mm-hmm. To move and to get rid of the house, I had to pay the movers, the first and last. Mm-hmm. The first and last, I did not have to my name. Mm-hmm. So it was, for me, more beneficial to stay. And the case in point is that you already have a payment that you know you're making.
Correct.
So why the hell does it matter what my value dropped to?
Correct.
When I have a guaranteed payment every freaking month, not to crack, that is actually cheaper than paying rent. Why would I, what would it matter if the house dropped in value?
And again, this goes to someone.
That was rent over.
I agree with you, because and I'm not talking about someone that owns a large real estate portfolio.
No, that was the only property I owned.
Exactly. If you own a primary home, if values drop, you're telling me, you're telling me you would vacate that to then go rent and pay a similar monthly payment
or higher
on something that isn't yours. And so I always,
and then, like I said, pay first and last.
Exactly.
And go through the pain of moving. I mean, seriously, come on.
Yeah.
Let's get real here.
And that's where I tell my clients, I'm like, yes, will it be rough? I'm sure it will be. However, you just need to get through that time, and then the values will bounce right back up. If history's taught us anything, is that this is a cyclical business, and as soon as the values go down, they after a couple of years, they bounce right back up, and that is at the point where you would take advantage. It's once you see those values start climbing up, and if you're wanting to upgrade or if you're wanting to move, that's the point that you would make.
The only time the values don't quite come back up is in the case of new construction. It takes a lot longer, and I'm beating that drum a lot lately.
Yes.
But I've noticed it a lot with clients, especially over the last few years, where if you're buying a resale home, meaning an existing house, your value goes up a lot faster.
Correct.
When you buy new construction,
it actually drops.
It actually drops because you're overpaying for new construction.
Correct.
So it's kind of one of those, touchy subjects to a point,
right,
or a personal pet peeve, I don't know, or both.
I always tell my clients, right, a lot of new build construction offers you 1.99 interest rates, right? 2.99. Where do you think the money is coming from to pay for these rates? Where do you think it's not made up? They're not giving it out of the kindness of their heart.
They're not philanthropic, right?
No, they're baking this into the price. If you look at these new build homes, they've gone from, like I said, 200 to 400, 500,000. That rate, you were prepaying for it in the price of your home.
And now you're locked into it.
Correct. Now you're locked into that price because you're buying that home at that price. And
no, I mean, you're locked into the payment.
Oh, correct.
Because if they bought your rate down.
Yes.
Now you're stuck with that payment, but God forbid you have to move.
You don't have
I'm not talking about the want to. I'm talking about have to.
Correct. Then you don't even have the equity to be able to sell.
Exactly.
Yeah.
Or you may be upside down.
Correct. And that's a conversation I have with a lot of my clients that do decide to go new build because, and no offense, a lot of new build lenders, they handle 100 to 200 clients a month. So
We're not politically correct here, so you're fine.
Them getting into the specifics, they frankly don't care. They have so many people they don't care.
It's literally take a number next.
Correct.
Take a number next.
And so I end up having to explain to them, when you buy a new build home, guess what else is going up? Your property taxes and your insurance. Because when you purchase a new build home, you are purchasing a piece of land, right? The county has assessed property taxes on a piece of land. Now you have a home built on it. Now you have a community built around you. Now in the new year, when the county goes back out and assesses these property taxes, you went from a plot of land to now a 4-bedroom, 3-bath house. Your property taxes are going to change. And that is something that is not talked about enough. I get a lot of calls from clients who had purchased new build and now are desperately wanting to refinance because their payment went up $500. And it's like, I don't understand why my payment went up. What do you know? Insurance, because now the house is a year old, and property taxes because they were originally assessed on a plot of land and now it's a home.
And if they did their mortgage with a new build lender, they absolutely got screwed on that because, again, and there's a class action lawsuit against D.R. Horton and I believe another lender.
Mm-hmm. I'm not surprised.
Because people's payments, they were actually qualified and closed the mortgages on the land taxes versus the future taxes, which we, on our end, we have to estimate.
Yes.
We have to make sure that when those taxes roll and they get assessed, you actually qualify for the damn payment.
We legally have to assess you we even take
we have to overestimate.
Right. We take a more conservative approach of what we anticipate your taxes being. And so, yes, a lot of new builds are being sued right now because the discrepancy. So, for example, if you came to us and asked us for an estimate, the payment estimate that we would give you had the county taxes assessed already. Whereas the new build, they would show you a monthly payment that was $150, $200 less. And so they were—
Or $500 less, depends on the state.
Correct. And they were drawing these clients in by saying, oh no, this lender, look at how much higher this payment is, without really explaining it's due to your property taxes. We have no control over that. It's not due to the rate.
I mean, honestly, here is a tip. Go to smartasset.com. Well, if you're looking at new construction, it's public access, smartasset.com. We'll plug in the state, plug in the county or a zip code and a price and see what it's going to show when you're looking at a new build, let's say on like Redfin or Zillow. Mm-hmm. Not a fan, but regardless, when you look at it and it shows you what the property taxes are based on the land assessment, the current one, not taking the new build house on it in consideration. Correct. Smart Asset will estimate decently, actually, as to what the property taxes will be when the home is finished. So plug in the purchase price and see what's going to happen to the taxes. It's going to be night and day between what Redfin shows or Zillow or the builder's lender versus Smart Asset, which is what we have to use because we have to make sure that a year from now
you can still afford your payment.
You can still afford your payment.
Correct.
I've literally had clients reach out to me who went with new build lenders and say my payment went over $1,000 up. Mm-hmm. Because now you're making up for the shortage for the prior year. And you have to pay forward to make sure there is enough in the escrow account.
Correct.
So all in all, you're like double the hit, basically.
Yes.
And it's like a gut punch.
Yeah. And that's something I've had to explain mortgage payments to new build clients so many times. And I have them send me a mortgage statement and I'm explaining, hey, a shortage basically means your account is overdrawn. Yeah. Yep. Think, when your checking account gets overdrawn and you're in a negative balance. That's how I explain it. I'm like, you are negative balance because of your property taxes and insurance climbing up.
The lender paid on your behalf. Now you have to pay them back.
Correct. Now you have to pay the lender back. And so what they'll do is they'll increase your payment not only to cover the amount that you're overdrawn, but also to ensure that moving forward, your account won't get overdrawn again. And so it's a gut punch because instead of just taking, if you're negative $500, instead of taking the negative $500 and doing a one-time payment, they'll increase your payment quite a bit to make sure that that doesn't happen again.
By the way, that also happens, unfortunately, and that's something we have absolutely no control over. Whereas on a new build, we can estimate.
Right.
But it also happens on flips.
Yes. Yep, that's a huge one.
Case in point recently happened to one of my clients. Their taxes more than freaking doubled.
Right. And flips we have no control over because, again, the county went out and assessed it before anyone had gone in and done all these renovations.
And we don't know when that assessment was done.
Correct.
So that's why we have no control over it. So overestimating on flips
Yes.
is outside of our purview.
Right.
Whereas on new build, there is a mechanism for it that we have to put in play.
Correct.
And we do have to document for the file on new builds how we arrived at the tax calculation.
Yeah, we have to include that for underwriting. But something, the fix and flips, like Ella said, we have no control and we don't know when the county goes out and does their assessment. Yep. I wish we did.
There's no calendar that's posted somewhere. There's like no
there's no
phone
like,
call.
oh, Maricopa County is going to be in January 2026. We don't know. You just get a notification that says, hey, your home's been assessed. Your taxes are going up or down or whatever, and we don't know when that happens. The best thing we can do is just advise our clients. And
that if you're buying a flip, be advised.
Your taxes might go up.
Yep, exactly. But at least we're upfront about it.
Right.
We don't know what it's going to amount to. We just warn you.
Right. Yes.
As opposed to new build where
you don't get
surprise!
you don't get any warning. You don't get any of this information. No one knows.
And I just wish we could get it out to more people, to be honest. Right. Because
hopefully people share our podcast.
Yes, and hell yes. So yeah, please share.
Please share. We're giving a lot of information
subscribe.
That's unknown. So
exactly. So we've pretty much beaten the dead horse of new build and new build financing to a pulp. And with that fun topic behind us, we're actually going to segue into something entirely different. And this is something that's also personally been bugging me every time it comes up. And this is a subject of I got a 3% mortgage or I got a 2.5% mortgage, let's say sub 3 for that matter. And I'm not trading that for the current 6%. I'm just going to keep paying my debt down on my own while having a ton of equity.
Oh my gosh. This is a point of anger and frustration for me.
And it's like,
yes, because it doesn't make sense.
And this is part of like financial illiteracy with so many people that just freaking blows my mind.
Correct.
Because they'd rather pay like a couple of $1,000 a month on bullshit debts.
Yes.
Than give up their 2.5% or 3% mortgage. Whereas when you show them what the new total payment is and they're saving like out of that $2,000 a month, they're actually saving $1,500. And they're still looking at you like a deer in a headlight, like I like my 2.5%.
Yeah, they don't understand. Yes.
Kill me.
We see that all the time where someone will have a $1,500 mortgage payment and then an $1,800 auto loan because their auto loan rate is 16% or their credit card rates are 29% and they're paying $299 a month for the monthly payment on a credit card. When you add all of that debt up, what you can do is you can refinance and yes, you'll get a higher interest rate on your mortgage.
But you have to look at the total debt and the payment.
Correct. That's where people are misunderstanding and that financial illiteracy comes up a lot because your total payment on your new mortgage will be much less and you're paying a much lower interest rate off the total debt than if you were to have everything split up. And that's where a lot of people actually end up drowning and spiraling because in order to keep—
While being equity rich at the same time.
Correct. In order to keep their 2.5% interest rate, they will drown trying to make these credit card and auto loan payments. And a lot of the time, they'll let their mortgage be late in order to make the super expensive auto and credit card payments.
It's like robbing Peter to pay Paul. What?
Exactly. I always tell my clients, if you're going to be late on something, don't be late on your mortgage.
Right.
Be late on your auto, be late on your credit cards.
Actually, auto before credit card.
Correct.
Although you don't want to go past 3 lates or miss 3 payments on auto before they repo your car.
Correct.
But funny thing is that a late on the credit card, a recent late on the credit card will drop your score by 30, 40 points.
40 points. It's big.
Whereas a late on the car, which is a loan, will be maybe 10.
Yeah.
And if that.
10, 15 points, you'll see the drop.
So kind of pick your poison.
Right. And before you even get to that point, that's where you would get, reach out to one of us and we'd review your file and say, okay, refinancing your mortgage, yes, you're going to get a higher payment. However, you'd get rid of that auto loan. You'd get rid of these high payments that are, keeping you strapped for cash.
It literally, again, is, it's not even financial mismanagement. It's literally the financial illiteracy.
Correct.
Coupled with stubbornness that stems from not understanding.
Yeah.
That you have to look at the total outgo. And if you averaged all of the interest you're paying on multiple pieces, the cars, the credit cards, the mortgage, that 2.5 or 3 on the mortgage matters not.
Correct. You're actually paying a lot higher. Yeah.
So you're just reducing your effective rate. Now you can take that savings. And frankly, if you don't like that 6% rate, great. The savings that you realize by doing a debt consolidation refinance, you can put that money right back into your mortgage, shrink the time of repayment, and reduce your effective rate. So, hello.
Yeah, it's a no-brainer. And something, too, that a lot of people don't realize is, like Ella touched on, if you take that additional money that you were paying and pay it towards your mortgage, break up your monthly payment biweekly, you're now not only reduced, the length of the loan, but also the interest rate that you're paying overall. But like you said, it's not mismanagement. It's truly that this isn't taught. No one learns about this. This is because it doesn't benefit
the financial industry.
Correct. It does not benefit the financial industry for people to know this. It benefits them to, okay, I have a credit card. I pay the minimum monthly payment at 30%. I'll just keep paying it till I die.
Yeah, but look at that credit card. Now, at least last couple of years, they've been obligated to show you a full disclosure of how long it's going to take you to pay it off if you only make the minimum payment.
Yeah.
So do you ever pay attention to that? Because if you did,
you'd be a lot scared of that than you would be of your interest rate going from 2 to 6%. Yeah. And if you're ever confused, you can print out the latest credit card statement. It'll tell you what your APR is and the total interest that you'll pay if you pay the minimum on the last page of that statement. And so I'll tell my clients, like, hey, if you have a lot of credit cards, print every statement, go to the last page, highlight the APR.
Yep.
And take a look, see what interest rates you're actually paying on these accounts, because a lot of people don't even know.
And the 2 strategies we talk about with clients a lot is, how do you attack? Okay, fine. You don't want to touch the mortgage. Fine. Be that way.
Right.
Like, literally be that way. We're at least going to show you a different way of actually working your way out of that wet paper bag with paying your debts. You were telling me with highlighting the APR, what?
Highlighting the APR and then attacking the highest interest rate credit card. So you want to, for example, let's say you have 3 credit cards and the highest one is pushing 32% and the rest are in the 20s. Highlight it, and the highest interest rate card, you can look at something called a balance transfer. Right now, I don't want to give promotion, but Citi has a lot of options where you can do a 0%.
Google is your friend?
Yes. Please Google. You could do a 0% APR on balance transfers for 12, 18, 24. I've seen something as crazy long as 36 months. So you can transfer the balance that you have on that 32% interest rate card to one of these Citi cards. There's a fee associated, but then what you do is you break out, let's say I owe $1,000. Now I have 24 months with 0% interest. I break up $1,000 by those 24 months. That's my minimum monthly payment. And
put it on autopilot.
Put it on autopilot, and it'll get paid off. And it's not accruing interest, so your balance stays the same. That is, I think, the most important, is by doing these balance transfers, your balance is not increasing. If you leave it with the current creditor that it's with, your balance will continue changing because it's adding interest every month. And
that minimum payment is literally just that. It's really not going towards principal.
Correct.
It's only pretty much covering interest.
Correct. It's only covering the interest. And so every month your balance will increase.
And then the way I tackle this, so we have complementary ways, is when I look at the client's credit and I see a lot of debt, especially a lot of little piddly cards with like $40 minimum payments, $60 minimum payment, $80 minimum payment. And sometimes those minimum payments are like on the balance of less than $1,000, which is atrocious. I think Apple GS card
Oh, yeah.
is one of those where the minimum monthly payment is like insane, regardless of balance.
It's like $40 or $50 a month.
Minimum. And I've seen it a lot higher than that. So instead of spreading your money around multiple cards every month, trying to like whittle everything down at the same time, try to attack the lowest balance card and pay it off. So pay minimum balances to everything else and focus on the minimum balance card. Pay it off and then take that monthly savings that you've realized from getting rid of it and apply it to the next smallest card and the next smallest card and keep rolling them up until you finally are able to tackle the big cards. Of course, maintain the minimum payments on everything, but don't try to spread your money around on multiple cards trying to make the impact because you're making none. You're literally on a financial hamster wheel, not moving forward. Exactly. You're running in circles.
Yeah.
So I know it's been a lot of info, and I think it's the info that everybody needs to know. I mean, there is so much that we didn't touch on because, again, there is something that with our passion and our knowledge, we could talk about for like hours, if not days.
There's just so much financial knowledge that we can give a client, and we can't put it all on the podcast because it depends on, what type of loan you're doing, what type of credit score you have. And these are, I would call it financial 101, I would say. These are a good starting point for someone who is either looking at buying a house, looking at upgrading, looking at buying, honestly, in the next 12 months. This is important information for anyone to know because if you're buying, you're going to find yourself either with a new build or a resale that you can take info from. You're going to have to file your taxes that you can take the tax deduction information from. High yield interest savings accounts, never too late to open one. So
balance transfers and credit cards.
Balance transfer credit cards. That's something right now I think in 2026 is the highest credit card debt that the U.S. has seen. And so I know.
And again, this is 2025 and 2026 so far is we have upwards of 40% with like 50% plus equity in their homes of mortgage holders.
Yeah.
And we have roughly 20% of people with homes that are free and clear. Yeah. And yet Americans are drowning in debt. Like, I'm sorry, how?
Yes, it doesn't make sense that our debt in America is so high. There's so many Americans drowning in debt, and yet this is the highest amount of equity that
Americans ever had. Yeah. So it just doesn't add up.
Right.
So that's one of the reasons why we want to get this information out.
I know.
It's literally the 101 that everybody should know. It's something that literally every freaking high school and college should teach. But they don't. I mean, I know I'm dating myself, and yes, I'm not a spring chicken. But they actually did teach home ec back in high school in the 80s and into the 90s, I think. And you learn how to balance your freaking checkbook. And now nobody has checkbooks.
No, we don't.
And I think the paperless actually
it makes it worse.
It makes it worse. And it's kind of to blame because everything is freaking paperless. So you don't see it. Because so many young people, they don't even realize that credit cards are real money that you're spending on the credit card.
Yeah. If you sign up for the Apple Card, immediately Apple will push a high yield interest savings account. And right now they have the lowest interest rate than a bunch of credit unions.
So there's a high yield and there is an Apple high yield.
Yeah, Apple high yield is not on par with the market.
Apple is owned by, Apple cards are issued by Goldman Sachs Bank.
Yes.
But
funny enough, if you were to go to Goldman Sachs directly and open up a high yield interest savings account, they'll pay you a higher interest than if you were to go through Apple Goldman Sachs.
In other words, there is value to homework.
Correct.
So just because something says high yield, it ain't so necessarily.
You have better options and a little bit of homework. Honestly, a quick Google search will show you which ones are paying higher amounts and doing local research too, like Ella and I brushed on credit unions right now, local credit unions, because they want to keep the money locally, will pay a higher interest rate. And those are hard to find with a quick Google search. You'll find the major banks, major financial institutions, but walking into a credit union, I think you'd find a way better deal.
But you can literally pull a list of credit unions, local credit unions, and their websites with a simple ChatGPT search in a matter of less than 5 minutes. And then you can drill down into their websites for their high yield saving accounts.
Yes.
And I'm sorry, if it's going to take you half an hour to an hour to do the homework, the money you earn, isn't it worth it?
Right? You can be making an extra couple $100 a month and you're making now an extra 100 for 30 minutes of work. It's a no-brainer.
To me, it isn't, but.
And if you can't do the homework, then we can't help you because that's the bare minimum.
That is the absolute bare minimum. Now, of course, I'd love you to like, to share, to subscribe. But more importantly, I want you to learn. And I want you to ask questions and not be afraid to ask those questions. Because I don't bite, at least I don't bite first. So ask away. There is no judgment here. And both Daisy and I will be more than happy to chat with you, whether in person or online, but answering your questions about more financial literacy or what we have discussed today, because there is a lot of amazing information that we covered. And Daisy, thank you so very much for sharing this recording with me, because I learn from you every time I talk to you about the financial literacy. I don't ever claim to know everything. I think none of us do.
Right.
So we just keep on learning and we keep on putting it out there. And I'll see you in the next one.
See you, everybody.